partnership is the association of individuals. Essentially, two or more individuals come together and form a business for the purpose of earning profit. A partnership has a limited life. If one partner withdraws from the partnership or passes on, that partnership ceases and technically a new one would have to be formed. A partnership can have mutual agency, meaning one partner in the business can bind all of the other partners in that same business to a particular contract or agreement. A partnership creates the co-ownership of property. That is a situation where any asset invested into the partnership becomes jointly owned by all of the partners within the partnership. There is no such thing as a partnership income tax. Rather, a net income or loss amount is allocated to each individual partner, and those amounts are reported on their individual tax returns. One thing that's similar to a proprietorship is that a partnership can have unlimited liability unless crafted quite carefully legally. That means a partner is not protected by a liability shield in a basic partnership. They could be litigated against for their assets within the partnership and their personal assets beyond the partnership. The introductory student needs to be able to do a few things. They need to be able to account for the forming of a partnership, the allocation of profits and losses, admitting a new partner, dealing with the withdrawal of a partner, and liquidating the partnership. This video will explore those key concepts without any sort of detailed numerical example. That will come in the next video. So for now, let's take a look at some of the key concepts. All partnerships require an initial investment. We'll take a look at a partnership that has two partners, Partner 1 and Partner 2. Partner 1 invests cash and a building. Partner 2 invests some cloud software and computer equipment. They combine these assets to form another business entity known as a partnership. The entry to record this initial investment of assets would be as follows. We would debit cash for the amount of cash contributed, debit building for the amount of the building. We would debit the software, which is an intangible asset, for the amount of the software, the market value that is, and the computer for the same. All of these assets would be valued at their fair market value at the time. We would then credit each partner's individual capital account. Not having their names, we can say credit Partner 1 capital for the market value of the assets they've contributed, and the same for Partner 2. The allocation of profits and loss. Profits and losses must be allocated amongst these two partners. But how? The answer lies in what is known as the partnership agreement, where there will be terms, clauses, and conditions that specify the splitting of profits and loss. Generally, we could split profit and loss by using either a fixed ratio, a ratio based on capital balances, or salaries, interest, and ratios. Note that salaries and interest here do not represent salaries expense paid out to employees, rather a predetermined amount that each partner is able to take from the company. These amounts will not show up on the income statement. Admission of a new partner. The admission of a new partner can happen in a few ways. Looking at the existing partnership, we could have someone else join the two partners that are already there. Admitting a partner in this way would result in taking the equity of the different partners and adding them up. For example, the new partner's equity would be added to Partner's 1 equity and Partner 2's equity. This would result in a brand new capital balance. Depending on how much of this capital is meant to be allocated to the new partner, this transaction could result in a bonus to either the existing partners or the new partner. Another way to admit a new partner would be for that new person to purchase the interest of someone that was already there. When that pre-existing partner departs from the business, leaving, in this case, 2 partners remaining. This is a good time to talk about the exit of a partner. When a partner exits the business, for whatever reason, we have to do a few steps. We have to update the capital accounts, and this could result in a bonus to the remaining partners or to the departing partner, depending on the terms and conditions of their departure. Finally, we can talk about the liquidation of a partnership. Remember the initial example where we had a partnership with 4 different assets. The liquidation of a partnership is really winding up the partnership as it will no longer continue to operate. There are a few steps the partnership must take, such as 1. Sell the non-cash assets for cash. What we expect after the sale would be cash left in the business, and we would allocate any gains and losses from that transaction. Also left in the business, presumably, would be some liabilities and equity. We would have to pay the liabilities with some of that cash that is on hand. All that's left in the business now is cash and the partner's capital balances, and so the final step is to pay the cash according to the capital balances to each partner. In the next video, we'll walk through all of those scenarios with a detailed numerical example. So we'll see you then. Thanks for watching.